Good afternoon, everyone, and welcome to our June commercial webinar on 1031 tax-deferred exchanges, something that is near and dear to my heart. My name is Maura Snabes, and I am the SVP Corporate Counsel for Corporate Settlement Solutions and am a founder of Corporate Exchange Services, a qualified intermediary for tax-deferred exchanges that we founded back in 1995. And with me today is Shelly Ashmore. Shelly is a CPA and received her Master's of Science Taxation. She has over 30 years experience in public accounting. She is a partner in the tax department at Gartland Niergarth in Traverse City, Michigan. Shelly provides compliance services as well as technical research and planning on a variety of complex tax issues. She serves a broad array of individual and business clients with significant experience in the oil and gas industry and specialization in mergers, acquisitions, and S corporation and partnership taxation, and of course, 1031 tax-deferred exchanges. Welcome, Shelly.
Thank you. Thanks, Maura. Thanks for having me.
Sure. And just before we get started, I wanted to mention, if you do have any questions at any time, please be sure to put those in the chat and we will address those at the end of the presentation. So, Shelly, I'm thinking before we get into the nitty-gritty and what we're seeing, maybe we do a quick refresher on 1031 exchanges for everyone. So a 1031 exchange is a method whereby a taxpayer can sell real property held for productive use in a trade or business or for investment, and then acquire real property held for productive use in a trade or business or for investment, and defer the payment of capital gains taxes. So one of the real important components of the 1031 to meet the guidelines are the timelines. There's a 45-day identification period. So within 45 days after you close on the sale of the relinquished property, a taxpayer has to identify potential replacement properties and identify that in writing, signed by the taxpayer to the intermediary within 45 days. And then the taxpayer has to actually close on the acquisition of one or more of those identified replacement properties within 180 days of the closing of the sale or the due date of the tax return, including extensions.
Yep. Mm-hmm.
Yep. And then using a qualified intermediary should be a mandate, because that is what solidifies that the taxpayer has no actual or constructive receipt of any monies during the exchange period. Can you think of anything else as a general?
Just a couple things would be that 45-day and 180-day. Those are hard deadlines. Weekends don't matter. Anything, it's definitely those periods. And then also it has to be specific. So you have to identify the properties. It can't be, a rental property in X city. It has to be the property that you're considering as a replacement property. So
Right. Yeah, good points. And yeah, on the deadlines, the only time that ever gets extended is if there's a federally declared disaster.
Yeah,
it's about the only time.
Yeah.
And you're right on the identification too, because I've had people say, haven't identified a unit in a condominium development. And you have to do that because you can't flip back and forth. So you're right. It has to be specific and identify a particular piece of property that can't be confused with any other one. So really good point. So you and I got involved in the industry's CPA, legal, and 1031 many years ago. So we've been handling 1031 exchanges for our clients collectively for well over 40 years. Over that time, what do you think has been the largest change or changes to Section 1031 of the Internal Revenue Code?
Yeah, so there's a lot out there, but I think of note would be the fact that we can do diverse exchanges now, which is, as you're talking about this, we typically see it where it's you're selling your first property and parking those funds with the QI with Maura, and then finding a replacement property. we can also do a reverse of that where you're finding your replacement property and having that parked again until you are able to find a buyer for your existing property. So that's been a change and a big benefit. Having the ability to improve property is another change that we've seen. So you might find a property that does not have the required value in order to defer your entire gain that you want to potentially improve. That again, you can have that parked with the QI and direct those improvements be made during the 180-day period, and then take title to a higher value property in order to defer your gain. So that's something that's changed. I know you've done a lot of those.
I have done both of those, and that came out in 2007, but some people still don't know that that's available, but I agree those two things were a really big change. Anything else?
Well, more recently, we've had the change with the Tax Cuts and Jobs Act that now only a eligible property is limited to real estate. So we no longer can do anything with personal property, either as part of the real estate exchange that would have to be looked at separately, or we've a lot of times had people, businesses that contractors exchanging equipment, or we've had taxpayers with aircraft that did exchanges. Those are no longer allowed. So it's strictly real estate at this time. So.
Right. And that was a huge change. And I know that there were some qualified intermediaries in the Federation of Exchange Accommodators with me that only did personal property exchanges. Okay. So they actually went out of business.
Okay. Oh, yep.
Yeah, that was a huge thing.
So, I mean, and with the law the way it is right now, we have such generous depreciation deductions for personal property.
Right.
So it's not necessarily a negative to the taxpayers because you usually, if you're reinvesting in something, you're getting a full deduction generally anyway, right away. Mm-hmm. So even though you're picking up the gain on the sale, you probably have a larger deduction for depreciation. But yeah, you're right. For those exchange parties, that would be that was their butter. That's too bad.
Right. But you're right about the depreciation, and that's the beauty and the value of using a CPA that is familiar with 1031s and all of the other other important aspects to not just 1031, but other things like depreciation and deductions and things like that. And you just don't find that with every CPA. So, so tell me, is a 1031 always going to be beneficial for a commercial property seller?
I think in general, yes, as long as you're intending to be reinvested in real estate, it's a tax deferral. It allows proceeds pre-tax proceeds to remain fully invested. So as long as that's your intent to be reinvested in real estate, it's a wonderful opportunity. There could be situations, I guess, if you do have other losses that you could offset, that you have available to offset the gain. That might be a reason not to do the 1031 at this time. So those could be capital losses, other ordinary losses, net operating losses as well that are carrying over. So that might be a reason not to do it. And then, another situation could be, we don't have a crystal ball, but if we think rates are going to be increasing, that could be a year maybe that you want to go ahead and just recognize the gain. But in general, it's advantageous as long as you're intending to be reinvested in real estate. So.
Right. Yeah. And that was my thought also. So for all of your clients who have approached you and asked you about doing a 1031 exchange, have there been any clients that you have said, no, this isn't going to be for your benefit to do?
No.
Okay. All right,
I
good to
haven't had
know.
that situation, so there could be those situations, but I've not had one where it wouldn't be a benefit for, so.
Right.
Yeah.
Right. And it's not you don't have to fully defer your gain.
Right.
Some people aren't aware of that. So you can
That's
partially
true.
defer your gain, and a partial deferment is better than no deferment whatsoever. So it's
Right.
not an all or nothing thing.
Right. And if you have, and that's a good point too, even if you're not intending to be fully reinvested in real estate, you can do the partial, you can invest in a lower value property and have a partial deferral and partial tax. So
Right.
that's a good point that, and I do see that quite often where it's a partial deferral.
Right. Yeah. I have taxpayers that pull money out at the closing of the sale. And understand that's boot, they're going to pay gain on it, but
Yeah.
they need that money. They want that money to use for some other purpose. So, which again is fine. They're going to defer the rest of it. So,
absolutely. Yeah.
So I always get asked this, and again, as a QI, although I'm an attorney, I don't act as their attorney. I do not act as their CPA, nor am I a CPA, so I don't profess to be one. But I always get asked this: what are allowable exchange expenses in a 1031 exchange? What are not? And then how are they treated? Do these expenses reduce capital gain dollar for dollar, or can you address that at all?
Sure. Yeah. And so most of the closing costs that we see on the settlement statement are going to be qualified exchange expenses, not all. So commissions, title insurance, qualified intermediary fees, those are all typically going to be, well, those are all qualified expenses, but one that's not thought of is tax advisor fees are also could be qualified expenses because it doesn't show up on the settlement statement. But those fees can also be qualified expenses. Things that are not are going to be your financing fees. So any kind of loan costs, points, appraisal fees for the mortgage, those are not going to be qualified expenses. Exchange expenses. And then the other thing would be that we see on the settlement statement are things like rent prorations and security deposit, association dues, that kind of thing. Those are not part of the exchange, but they are generally going to be reportable on other areas of your tax return. So whether, depending on which way it goes, it'll be income or deductions in other areas of the return, but not part of the exchange. And yes, the exchange expenses will reduce your gain, your exchange gain, dollar for dollar. The qualified expenses will. So,
Okay.
Am I understanding that?
Yeah, that's perfect. So sometimes I get asked by a tax, well, often, like 99% of the time, what I do is if I'm holding enough exchange funds, I will advance everything that the buyer taxpayer needs for closing of the replacement property. And so if they're getting a mortgage, that may include some mortgage expenses. How would you, or how do you advise your taxpayer to deal with that? Do you have me as a QI advance everything like we typically do, or would you have your taxpayer come in with cash to cover those, or would you just assume maybe the mortgage amount is going to cover that? Can you answer that? I don't know.
Honestly, I'm not always at the front end of that to be able to advise, but either having the cash put in to cover those expenses, or yes, looking at the mortgage that's being taken on to make sure that there are no surprises there. In most cases, the big thing is if the mortgage is overall, the debt on the new property is less than the debt on the existing property. That's usually the bigger thing that we want to look at, because that would be considered boot, and that reduction in the debt is boot, and it's going to create a portion of it that's going to be a taxable gain.
Yeah, and that leads right into my next question, actually. So there is a general rule that you have to trade up or equal fair market value and equity in order to fully defer your gain and reinvest all the net proceeds that we're holding. So that's the very general rule, and that's what we can tell taxpayers as QIs. But what isn't addressed with this general rule? So mortgage boot would be one thing.
Right. Yeah, and that's a surprise to some taxpayers for sure. So that is something that we try to bring up just so that they're fully understanding. And some of it depends on, just looking at the property relinquished, the values, how the values compare, the relinquished versus the ones they're replacing with. So, but if it's close to being an issue, then we do want to definitely look at that, all the pieces of it, and let them know about any debt reduction is going to be considered cash boot, and there will be a portion that's taxable. Yeah.
Right.
And then as far as exchange expenses, which we're talking about, those are, any exchange expenses on your relinquished property.
Yes.
Are going to, in general, basically, I like to think of it as reduce the fair market value in that property that you need to cover with your replacement property.
Right.
And any exchange expenses on a new property are going to add to your fair market value of your new property that you pay for the new property. So it's not just the cost of the property itself, but we need to look at those adjustments for exchange expenses too.
Right. And again, that's where we direct our taxpayers to you or people like you who can get into the kind of nitty gritty, because all we do is give the general rule, and then we advise them to speak with their CPA or tax advisor. So,
and all of this has to be quantified on the form that gets filed with the tax return as well. So the liabilities, any other property received or given up, and as well as exchange, these exchange expenses that we're talking about. So that all is part of the reporting process that we have to do.
And that's the 8824?
Yes, correct.
Yeah. Okay. So how often do you see 1031s getting audited? And I hate to say this out loud.
I know.
Without knocking on wood. But
yes, me too. I have not seen any audits in my career, so thankfully, and hope that continues. I don't know. Have you run into anybody that's had any issues with that?
Knock on wood, I have not also.
Good.
And what I tell taxpayers, and you can tell me if this is accurate, is that really the IRS doesn't do random auditing, and doing a 1031 doesn't red flag your tax return to get audited.
Right. Yeah. No, that's absolutely right. And and thinking back too, they do desk audits at times or just request additional information. I've not had anything like that at all on 1031. So
no, I haven't either. And hopefully that continues.
That's right. Exactly.
Yeah. So overall, what do you see as the largest or the greatest advantage of someone doing a 1031 exchange?
So again, it's, someone that is wanting to continue to be invested in real estate. There's no reason to even if it's a partial deferral, like you mentioned. But the greatest advantage is the tax deferral. They have, there's a combined tax rate that you pay on this type of a gain. So there's going to be, for any depreciation you've taken in the past, there's a 25% rate. And then there's going to be a 15 to 20% rate on any further capital gain over and above that. And then we have the net investment income tax that applies to capital gains. That's another 3.8%. And then you have your state tax, which Michigan is currently at 4.05%. So adding all those up, your tax rate is going to be, depending on the depreciation you've taken in the past, it's going to be between 28 and 33% that you would pay on the gain on this. So being able to leave that additional third of your proceeds reinvested is, a huge advantage and opportunity. So,
Right. In addition to other things too, right? You can diversify.
yeah,
If you have vacant land and you want to acquire maybe something with a rental stream, you can do that, or
right.
move locations.
Mhm.
So,
You can do it
and
across
then,
state lines too.
yep, yeah,
Different
exactly.
states. Yep.
Yeah. And then there is a complete elimination at this point in time of gain, in only one circumstance that I know of.
Mhm.
And that is death, right?
Correct.
Yeah.
Yeah.
So,
That would be another advantage, is this could be a permanent deferral in the case where the taxpayer holds until passing, and then the beneficiaries have a step up in basis in that asset, and it
right,
will never be, that gain will never be taxed. So,
right. I
yeah.
mean, not really a great advantage to the taxpayers
No.
themselves, but
No.
but that is the way to have it completely
Right.
excluded if the heirs or beneficiaries sell at the stepped up basis.
Yeah, but I do have taxpayers that they are, heavily invested in real estate, and they continue to do 1031.
Mm-hmm.
And they do have, that is part of their estate plan, is that
Right.
they're holding those properties for their heirs, their beneficiaries.
Right. Right.
Um,
Yep.
So that's actively happening, and it's not a bad plan. I mean, they're already, and if they can exchange into new properties that might be more fitting over their lifetime, but
Mm-hmm.
but that's definitely a component of their estate plan. So,
Right. Yeah, I've seen that also. So,
Mhm.
do you know of any latest case law or revenue rulings that may have changed anything that we talked about today?
I don't offhand, honestly.
Okay.
The only thing I'm aware of right now is just the Biden's administration and his budget that came out for 2024.
Mm-hmm.
And that again has the proposed limitation for like-kind exchange at the 1 million for a married filing joint taxpayer, and then at 500,000, for single. So it was in there in the 23 budget as well.
Right.
Hopefully that doesn't occur.
Right.
I don't know how much traction that has at all, but
Yeah, I'm thinking it won't pass. Didn't pass before. I don't think it will. It would have a significant effect on 1031 exchanges.
mhm.
And who could then do a 1031 exchange, effectuate one, but
Right.
I really don't think that's going to pass. So,
Yeah.
um,
Have you seen anything recently on any case law or regulations that,
not really.
okay.
Just
been status quo.
emails about the Biden plan, but,
Yeah.
and the Association of Exchange Accommodators has a lobbyist that
Mhm.
is talking to congressmen and women
Mhm.
about not passing that. So,
Okay, good. Yes,
So-
I read that as well. So,
yeah. So
Mhm.
your neighborhood and my neighborhood, we have a lot of vacation type homes and investors. And the IRS a few years ago said that a taxpayer must hold a property for 2 12-month periods. I don't know why they didn't say 2 years.
right.
2 12-month periods prior to and following the exchange
Mhm.
as qualifying property or rental to be within the safe harbor.
Mhm.
What are your thoughts about that? And what if they don't quite fit it? So what if they hold for, 23 months or 20 months? What are your thoughts about that?
Well, I've not had that occur. We try to coach taxpayers into fitting within the safe harbor. Technically, it's a safe harbor, so that doesn't mean that it necessarily would be disallowed. It means that's a safe harbor. So
Right.
it probably depends on the taxpayer's risk tolerance.
Mhm.
We have to look at all the facts, but again, we try to coach into having meeting the safe harbor and continuing to have, increased rental usage if you're thinking of selling a vacation home under 1031, and limiting your personal use,
Right.
and just documenting those facts. I mean, having a plan to do it so that we do fit within it is kind of what we try to do. So I'm not
Right.
having one that's not fit the safe harbor.
Mm-hmm. Right. And it's my understanding they look at things like intent of the taxpayer,
Yes.
which, I'm not sure exactly how you determine that, but
Right.
there are ways, I guess.
Kind of in your head. Yeah.
Yeah.
Uh-huh.
Climbing in your head.
Uh-huh.
And, if you rent it out doing K1s
Mhm.
and as far as personal use, is that still the 10% or more than 15 days out of the year? Is that still the qualifier, if you will?
Yeah.
Yeah.
Keeping
Okay.
it less than, yes, the 15 days or 10%
Yeah.
of the other rental use. Yes.
Okay.
Yeah.
Good to know.
Yeah.
And you had mentioned in talking about things that were new on 1031s or had the most difference and impact on 1031s in the past so many years. And we talked a little bit about the improvement exchange, where a taxpayer may sell an improved property, take that money, want to acquire some vacant land and improve it. And that's great. There's a vehicle to do that now, but just a qualification on that, you can't make improvements on land that you already own because that would not be considered real estate. There are some ways around that, and that would be if a related party owned that replacement property and you do kind of a 30-year lease back. But again, we're getting into more complicated things, but just wanted to throw that out there too.
But there is that option if you already own the property. Yeah, great point.
Yeah, and we have done maybe two since 2007. So not a whole lot. And again, some of it is risk tolerance of the taxpayer because it's not necessarily fully within that safe harbor.
Right.
Which if you're within the safe harbor, that's where you want to be, and you want to be golden, if you will. Where you're pretty confident if you get audited that it's going to pass muster.
Right.
And again, anything out of the safe harbor, it still may pass muster, but it just gets a little more complicated and scary for a taxpayer if they're not within that safe harbor. So
sure. And I'm sure we did one of those two with you, right?
Probably.
I remember. Yes.
Yeah. I was probably the guinea pig. Yeah, it's good. That's how you learn is to take on new types of things. So,
and it all by the way.
Thank you. Knock on wood again. We're almost out of time, so I'm just gonna look at the chat, and we have just a couple questions. So, is there a mandated holding period within the Internal Revenue Code? And how long do I need to hold on to property that I acquire in an exchange?
So there's not really a mandated time in the code, other than if you have a related party exchange. I'm sorry, I missed part of that.
Yeah, so how long do I have to hold on to property that I acquire in an exchange?
Yeah, it's not mandated. You could, we like to see a year. It's more the use of the property, if it's investment or trade or business property, and it's not personal use property. So that is more the key. If there's another property that's found in a short time frame, you could exchange again or sell if that's the plan at that time. But so no, there's not really a mandated time holding period.
Right. And that's my understanding too. Again, like you said, though, except with maybe a related party exchange where you sell to a related taxpayer, then it's 2 years. And last question we have is about refinances post-exchange. So is it allowed to do a refinance after I acquire 1031 property and have that money be cash-free or tax-free, basically?
So yes, it is. That is an option and a good one. You just really, when we're doing the exchange and what we have to report, we're reporting the debt differences at the time of the exchange itself. But after everything is closed, that debt could be refinanced and money taken out. So you you want to have a high enough debt that you're taking on initially in order to avoid the gain,
Right.
defer all of your gain. But then after, the transaction is closed, fairly soon after, you could refinance that and get some cash out, and that not affect the like-kind exchange and the gain.
Okay. So is there any period of time that you advise your taxpayers to wait to do that? Or, I mean, is it 30 days? Is it 3 months? Is it a year?
We generally would say more is better, and that we would like to, distance is always good, but again, honestly, I would say we never have that looked at.
Right.
But I would, I don't have a particular period of time that we advise, but just a little distance. So probably wouldn't do it the next day or next week or anything like that.
Right.
But,
Yeah.
a couple months out. Yeah, absolutely.
Right. Yeah. And there's nothing in the code or regs or anything like that that addresses it. So,
Yeah.
Well, good. I don't see any other questions.
Okay.
So I want to thank you again, Shelly, for agreeing to co-host with me and be a panelist. And thank you everyone that's out there listening. And we are recording this, so it will be on our website pretty soon after we get done here. So thank you again. And I look forward to seeing everyone virtually at our next commercial webinar.